You'll hear us talking about term sheets. If you never had an experience about what is a term sheet, it's an outline, it's a guideline. It's not a legally binding document. It's probably a page, maybe two, three at the most, and then it's going to list out all the terms that we agreed with. Convertible notes, a loan that converts into equity, usually converts into common stock, and historically this thing was a bridge. That has changed a lot over the years. Sometimes you get convertible notes or safes that will last years. Y Combinator came up with this idea of doing this thing called a safe, a simple agreement for future equity. It's a contract. It's not debt technically, but it's definitely not a loan. If you talk to some of our lawyer friends, they don't like them as well, because if you actually have a convertible note, you have debt. So if the company does go dark, you have some rights as a debtor to the assets of these companies. And then when you ask, so what do you think the assets are for a company that you put $100,000 into and has now gone bankrupt? There's not much there, which is why the investors have largely just capitulated and said, yeah, we're fine with safes. So safes seem to be the way of now and the way of the future. There's something called a valuation cap. And as an investor, when I invest, there's usually a little bit of a tussle with the founder about, is the valuation cap pre-money or post-money? Post-money is what's the value of the company after the investment has been made. Most investors think of their investment in terms of post-money. As an investor, you don't really know exactly what percentage of the company you own until they've finished raising. So from an investor point of view, we always like a post-money valuation. If you're investing at a $5 million valuation cap and a 20% discount, which would be very common, you want to do the math and say, well, if this company converts they go out and raise another round at $15 million, is it better for me to take a 20% discount off of the $15 million raise, or is it better for me to insist on a valuation cap that I have of $5 million? If the company's doing well, it's almost always better to take the valuation cap. If the company's struggling, that's the time when you would want to take the discount as opposed to the valuation cap. It's the investor's choice, and it's just a simple math problem to decide which one you want to take.